Hi everyone, it's Jack back with another video. First video of the new earnings season. Earnings released for Netflix last night, down 25% pre-market, now down 20% on weaker subscriber growth numbers than expected. Must be said against strong comparisons of 2020 pandemic numbers. Only 18 million subscribers added the whole last year, half the level of 2020, and they've warned of a slow pace of growth over the coming months. It's lost a fifth of its value. When this happens, it must be asked, are we in oversold territory? Netflix was nearly $700 stock in November. It's now down 42% from these highs, 20% in just one day today. Company has been absolutely smashed in the last few months. These rough few months may have presented a reasonable buying opportunity. I think it's time to analyse the wider business. This has, of course, been a fantastic stock to own over the longer term. As far as content goes, Netflix had a pretty strong year. From the Google search numbers at the top of the screen, you can see Squid Game and Bridgerton, the two most popular search TV shows, and Netflix have 6 of the top 10. Disney Plus has number 3 and 5. You can see the competition for TV shows is definitely growing, but Netflix has proven that its strategy of generating original content is working, and this has provided a good exposure. In movies, much more competitive space, they're often competing with not only cinemas, but with Disney Plus and other entities bringing out their movies in an exclusivity window, which Netflix isn't really offering. They only have 2 of the top 10. These are some major names. Again, Marvel-backed IP is going to be tough to compete with for Disney. Overall, the space is getting more and more crowded, and Netflix's first mover advantage is getting whittled away. They still have great, exceptional hype around the TV shows, and they have a continued competitive offering there, in my opinion. As far as the weekly global paid net ads this year, they've returned to the mean. There's been a decline in subscriber growth for a long time. As you can see, from 2018 to 2019, it was a lot less drastic. But in 2021, there's a clear decline, and it's expected to go further for 2022. 2020, clearly just a freak year because of an obscene number of pandemic ads. As you can see, from March 2020, it really reverts from what would be the mean. So that much is obvious to me, that they had tremendous pandemic pull forward, and the subscriber growth is really not happening at the minute. That being said, the growth is upwards. They're not losing subscribers, so this is pretty positive for me, especially with the price rise they've done. I think this is positive to show that they still have some pricing power left. The 2022 forecast is slightly worrying, in my opinion. From a financial standpoint, the picture for Netflix isn't all rosy either. Netflix has a decent amount of debt on the balance sheet, and the cash position is not particularly strong. Cash to debt of 0.49. I would like this to be better, but versus the industry, it's not so bad. This is a very capital intensive business. They have to pay a lot for outsourcing content, as most companies do, but this needs to improve going forward. They have reasonable interest coverage, and the debt to EBITDA is okay at 0.84, so I'm not particularly worried. The Altman score of 6.5 indicates this company is not at risk of financial default, so I think as far as financial terms go, this is a relatively safe investment in terms of risk of financial distress, but it has points for improvement. The profitability picture is excellent. Netflix has reaped the benefits of heavy investment in original content and has built up a strong backlog, reduced its over-reliance on outsourced content, and has built itself some nice IP in the form of Stranger Things, Squid Game, Bridgerton, things like that, and developed itself some pricing power. 18% net margin, 23% operating margins are both pretty strong for the industry. Return on equity percentage of nearly 40% is absolutely outstanding. Return on assets percentage of 12.5% is excellent. Most importantly, these are all trending upwards, which is exactly what you want to see. This business in profitability terms is firing on all cylinders. This is further illustrated by these graphs from macrotrends.net. Trailing 12 months gross margin, operating margin and net margin are all at pretty much the highest they've ever been. 43% gross margin, 23% operating margin, 18% net margin. You can see the improvement from the mid-2010s. Absolutely excellent. This is a business that, in profitability wise, is absolutely firing on all cylinders and is in the best situation it's ever been in. Following on from that, Netflix's PE is the lowest it's ever been in Netflix's history. Of course, the company wasn't always consistently profitable, but now it is. It's trading at price to sales of just 6 and a forward PE ratio of just 31. Cash flow is, of course, still a problem, so free cash flow metrics look absolutely ridiculous. It's an enterprise value to free cash flow of 1,500 and a price of free cash flow of 1,200. They definitely need to sort out their free cash flow situation, but to me, I'm not so concerned about that. 30p for a company growing 20% revenue per year with reasonable pricing power and 40% growth margins. To me, 30p seems completely reasonable on the face of that. The next stage of my analysis is doing a discounted cash flow valuation to work out the intrinsic valuation, fair value, and what margin of safety I'll be getting. So for this, I'll be using earnings per share because, as I've mentioned, the free cash flow is a bit wonky and it's not as consistent. The earnings per share numbers over 10, 5 and 1 years for me feel very optimistic at 39%, 92% and 79% respectively. So I would rather use revenue growth because profits will be roughly in line with this, in my opinion. So using 20% revenue growth for the most recent year, I think revenue growth will be relatively consistent at 20%. I think perhaps optimistic, but I think this is a reasonable evaluation of what Netflix earnings per share growth will be. I've used 8% for the long-term return of the stock market, and putting this into the calculation gives a fair value of $467 versus a current price of $410, indicating a reasonable buying opportunity below fair value with a nice margin of safety of 14.4%. And I don't think these are unreasonable expectations for Netflix to continue to grow at 20% for the next 5 to 10 years. So how does the stock look now? At $400, Netflix is a $180 billion business, trades around a 30 forward PE, around 15% discount to our calculated fair value. This seems like a reasonable buying opportunity to me if you believe in the long-term prospects of the business. The subscriber growth will eventually tail off. It needs to increase its international numbers, but for now, 18 million net adds doesn't seem that ridiculous to me based on the prospects of the business. The business definitely has pricing power, raising prices recently. I just question how much. The highest end package is now $20. This is no longer a forgettable expense for most households and most people. The basic package at $10 still has room for manoeuvre, but there's definitely a point where it becomes expensive relative to the other offerings. Disney Plus is cheaper. Amazon Prime is bundled, so it's much cheaper. Disney Plus also has the bundling options with things like ESPN Plus and Hulu. So you can see how the value proposition for Netflix will start to decrease and the pricing power will start to decrease, in my opinion. There is some optionality here with a pledge to branch into gaming and perhaps other industries, but again, I question how much optionality there is here and I question how much this will be taken up. The industry has got significantly more competitive over the last few years, so I think Netflix 20% revenue growth per year will be pretty much the top end in my opinion, and I don't think the company has tons of brand equity. It's still the premium brand in this industry, but again, if Netflix becomes suddenly prohibitively expensive to a lot of people, the brand won't mean that much. I like the business and I like the prospects for the next 5 to 10 years. I think it's very hard to imagine this company being smaller now, but again, competition is really tough and other companies have IP in abundance, things like Marvel at Disney, Star Wars. This is going to be a problem for Netflix going forward unless it can create a lot more strong original content offerings as it has done this year. But again, I believe in Netflix. I think it's done really well so far. I think it's been an excellent stock to own. I think it will be an excellent stock to own for the future. I definitely think it'll outperform the market. So I would be happy buying at this price. I'm not going to. At this price, I would prefer it to be slightly lower because I think there's still room to be had. We're in a bear market at the minute for growth stocks. I think Netflix has some way to go down. I would be happy buying in around the $350 range, but I do not think this is an unreasonable price. I think it gives some margin of safety. With that being said, this is not financial advice. I'm not encouraging you to buy, sell, or hold this company. So if you need financial advice, you should go to a registered financial advisor or do your own research or both. That being said, if you're enjoying the videos, please like and subscribe. Thank you. Bye.